right. Did you guys get a chance to look at what we did yesterday rather, in terms of the Spur Tree Jamaica Limited balance sheet? And some of the questions that I'd asked in terms of what you may have noticed, or how you are able to identify your own assets and liabilities of your own business. Anybody was able to look at that and would like to share?
Forget to check it out. But one thing I did notice was I never understand how they was losing money in the following year. That's something I have to look into.
Or they were losing money? Did you look to see if their expenses went up?
No, I'm pulling it up right now.
All right, we're gonna go some more into that. But Matthew, well, you would have done this some time ago. So let me ask the others, in terms of your assets or liabilities, were you able to identify what you have? Let us start with assets. For your particular business, what kind of asset do you have? Tanisha, tell me first. All right, Abiathar, what kind of assets do you have in your business?
My assets would be my vehicles. I have 3 vehicles.
Okay. So Nicholas has vehicles as his assets. Anybody else can identify their assets based on what they do? Tishana?
1 second. I would say we have our computers, we have projector and other tech devices that we use to deliver training.
Okay, so you have equipment.
Yeah, and then I guess software. I don't know if software is considered assets.
Yes. Software
Okay.
is an asset as well. Intangible, you can't really see it,
Yeah,
but you know it functions.
right.
Right,
right.
miss. So sorry about that, miss. Was configuring the stuff around. I'm using 2 screens. I'm trying to multitask this morning. But good morning, everyone. So the assets for Nita's funeral services would be our computers, as Tishana would have said earlier, and some other little stuff like church trucks and stretchers and so on and so forth. We do not have the lump sum of assets because we outsource most of what is required to do the service currently, as we cannot afford certain stuff, so we outsource. So we wouldn't have the earth and so on and so forth just yet.
Okay. All right, good. Thank you. Tanisha is back.
Yes, I'm here. Sorry. All right, so for me, okay, for my business consists of tangible and intangible softwares, motor vehicles, computers, stocks would come under asset, correct?
Inventory, yes. I was waiting to hear that.
Yes, so basically.
Right, so you guys have some things that are similar, some things that are different. But as long as they're assets, they're treated similarly. All right, we're gonna get into that in a little bit. So what is going to happen now is that you're going to see a poll on your screen. Robert?
Yes. Yeah, a little bit more time.
You need a little bit more time?
Yeah,
Can you send number one?
Yes.
All right, send the first one. So we're gonna do them one by one, Robert, because we're gonna poll and you're going to answer the question that you see. Okay, so your first question, the following are business types except, so I want you to choose the correct answer for one. Sole proprietorship, sanitation services, partnerships, limited liability companies. Which one of the following is not a business type? One answer I've seen so far. Two answers.
That's the complete question for number 2.
Number one, you're looking at, Matthew. The following are business types except, so you're going to choose either sole proprietorship, sanitation services, partnerships, or limited liability company. Which one of those is not a business type? All right, so it's 4 of you, right? Am I missing somebody? Yes. All right, so everyone chose the same answer, which is sanitation services, and you are all correct. So all the other 3 are business types, which we looked at yesterday. Sole proprietorship, which is just one person. Partnerships, which may be 2 or more, or a limited liability company. All right, so good job. The next one, what happened there? Bookkeeping involves all of the following, except, oh, I'm not seeing the choices.
1 second.
Okay,
Oh, I have to end it first.
okay.
There you go.
Yes, all right. So bookkeeping involves all of the following, except, all right, proper record keeping, storage of documents, analyzing of financial information. Which one of the following is not a part of bookkeeping? Two of 4, 3 of 4. Y'all are on the ball today, so I'll end the poll. And there you have the answers. So it is analyzing of financial information. And where does analyzing of financial information fall if it is not a bookkeeping process?
Accounting.
That's right, accounting. So proper record keeping and storage of documents, along with some others that we had looked at, are all a part of the bookkeeping process. Analyzing of information is what you get from carrying out proper bookkeeping processes, and that forms a part of your accounting. Number 3.
I just made it and it disappeared.
Okay, all right.
Just give
So
me
number 3 disappeared. All right, let me
just
see.
give me 1.
Yes, Miss Karen, interactive class, I go on, man.
My dear.
While he's doing that, at 10:15, I would have to log out temporarily and return at 10:45 to do something at work, to take a
Okay.
quick urgent meeting.
Multitasking today.
Yes, yes.
All right. All
Well,
right.
not multitasking today, but this thing was on my diary before,
Okay.
because our sessions are scheduled along the way, so it's already on the diary and it's difficult to get out of.
No problem, Tishana. I understand. All right. Number 3. So you're going to have to tell me the answer while we try and sort out those technical difficulties. Oh, it's up. All right. Thanks, Robert. Number 3, the accounting cycle begins with the financial statements. Is that a true statement or is it false? The accounting cycle begins with the financial statements.
Yeah, it starts with source docs. I would say, oh, wait there. The answer.
2 or 4. Halfway there. Three. All right, so we have shared the results. All right, so this is what we have. 1 person said true, 3 persons said false. All right, the person that said true, tell me, speak to me, why you say it's true. I can't tell who said true, so somebody has to own up. No. Who said true and why?
Oh, well, I think that was me.
Why?
Maybe I was mixing up financial statements and source documents.
But I heard you in the background, though, Matthew.
Yeah, well, I would figure you have to start with your statements to can move forward to assess where everything is at.
I guess I mix up
And you
statements and
were
source
actually
documents.
saying accounting cycle begins from the source documents. You have to have your source documents in order to be able to generate your financial statements, because that's where you get your information from. Right?
Right. That's also I say I was mixing up source documents and financial statements.
Okay.
Because if I'm correct, it actually come last.
That's correct. Comes last. Because
Right.
you get all of that information from the source documents, you put them together and you get your financial statements.
Right.
Miss
All
Karen,
right.
when you look at some accounting cycles, after we get to, because I guess the whole accounting cycle, the point is to take you through the process that takes you to the final production of the financial statements. But it will tell you that like the last step is closing the books. What does closing the books involve?
Closing the books is really saying, okay, this is the end of it for the period you're working in. You are not going to do any more transactions in that period. So let us say you have a 12-month period and you have put in all your transactions. Usually you say, I'm not putting anything else there. This is what it is for that 12-month period or whatever period it is. No more transactions are going forward. So whatever you open the period. So it's like you close a door and nobody can get in, and somebody with authority have to actually open the door or open the period for you to put more transactions. So it's just stopping all financial transactions for that at that point in time. So whatever you earn as profit or loss, that is moving forward into the next period or the next year. next month, whichever one you have it for. Got it, Tishana?
Yeah, I was just wondering what physically takes place. It doesn't mean that you do anything, because once you produce
Yeah,
the
so and as I was
statement, you know,
saying,
that you are saying to
if you're
close out the
using an
period,
automated
everything that you say, that's
if you're
you
using
put
an
current cutting
automated
out for
system,
you were going in and out.
okay, no, I was saying if you're using an automated system, you actually close, you actually perform a process of actually closing the books.
Okay.
That's the term that we use. But what it entails is just stopping all form of transactions from going in the period that you were working in before.
Yeah. Okay.
Mhm. Got it. All right. Okay, Robert, it's 2 more.
They are already.
Hmm?
They're already the last two.
We did all of them already?
Oh, 2 more. They're
Oh,
already.
yeah. So you can show the next one. All right, question 4 of 5. If I need to see the details of transactions in an account, I would look at the journal entries, the general ledger, or the trial balance. So if I want to know the details of my transactions, where would I look? Two of 4. Waiting on 1. All right. And the poll. Share the results. Okay, so the person that says general ledger, please speak. The person that says general ledger.
Yes, that's me.
Nicholas, all right,
Yeah.
speak to us now. Why did you choose general ledger?
I just assume that general will be everything basically.
I love that. You just assumed.
Yes, general will be
That,
everything.
okay, all right, but guess what? Guess what, Nicholas?
I'm listening.
You, you assumed correctly.
Thank you.
All right, and other person said the journal entries. All right, remember that the journal entries come after your source document. So this is where you actually take those information from the source document and start to record them. So this is where you start your financial statement. You start putting the information together to get your financial statement, to get them details of all these transactions. Because remember, you're going to be doing journal entries. Today you do a transaction, tomorrow you do a transaction, 10 days after you do a transaction. So you'd have to sit down and go back through these journal entries to find out what you're looking for, right? But the general ledger now just shows a detail of the particular account. So if I want to see what took place in the bank account, I could go in my general ledger, find my bank account, and I will see all the transactions that were ever recorded in the bank account, that particular account. If I want to see what went into repairs and maintenance, I could go straight to repairs and maintenance, and I will see all the transactions day by day, value in terms of who you bought things from, who you paid, and so on. You'll see everything there. So the general ledger is where you would find the details. The journal entries are just a way of getting the information from your source documents in your accounts. All right? So general ledger is what it is. Final one now, Roberts. All right, so the final one, the income statement, or what others would call the profit and loss statement. Some persons call it profit or loss statement. Some call it statement of comprehensive income. Will provide information on whether a department or activity is profitable. Is that true or is it false? And someone was quick to the draw. So what do you all say? 2 or 4? All right, someone has not answered, but all right, good. So one person said false. Who is that person? Can you tell me why you said false? Who said false?
Me, miss. I thought the profit and loss would be the entirety of the company, miss, and not the specific departments and activities per se.
That in your profit and loss, you can report by department. So you may know, okay, if you're doing a particular service, you're doing a particular activity, then you would know what you're earning from that, what your costs are, and then you will know if it makes sense to keep that particular department or keep that particular activity going. Because what the income statement does, it shows you your revenue that you're pulling and it shows you your expenses. So you may have your income statement as a whole, and you will look at your funeral supplies and you just see you getting funeral supplies. But suppose embalming is not a segment in your company that's making a profit, right? You may choose to look at it, which means that when you are reporting in your financial statement, you may need to record by your activity. So you may choose to set up your account in such a way that you can see what's happening in embalming versus what is happening in cremation versus what is happening with, I don't know, straight burial, however you call it, right? So you may see those 3 things as the main activities you do in your business. And instead of lumping them up together, you may want to report on them separately. So when you look on your income statement, you can see what is happening segment by segment, right? And then you will know, okay, this one is the one I'm making more money off. So maybe I need to keep this one going. I may need to pour more funds in this particular one. And whether you scale down or you terminate a particular one that's not doing as well.
Understood, miss. Indeed.
All right. Thank you so much for participating. All right, so let us move on. Am I going in and out? I'm getting a message that my internet is unstable. Are you hearing me well?
You are a bit in and out, miss. I was wondering if it was on my end.
All right. Let's pray that it holds up. All right, so what are we doing today? So we're going to look at some accounting terms. Remember, you looked at the financial statements or an extract of the financial statements for Spurtree, and you would have seen some terms on the balance sheet. Some of you may be familiar with them, some may not. And I mean, we spoke about asset, which is one that should be sitting there. So we're going to look at some terms and some examples. We're going to look at what we call the double entry concept, which we spoke about in your pre-test, where we said what the double entry concept was. We're going to go a bit further with that. We're going to look at the accounting equation. We're going to do some journal entries, and then we're going to run a lap. We're going to just go through the accounting cycle, starting from the source documents, going around to the financial statements. All right. I mean, remember that this is not to make you accountants, but if you want to be made an accountant, then more power to you. So as we go along, you can ask your questions and we will see how best we can answer those. All right. So let us start by looking at some accounting terms. And we are going to use the balance sheet from Spurtree. Of course, you will notice that it says statement of financial position. It is the same balance sheet. All right, what were some of the things that I asked before that any of the terms that you see on the balance sheet that is not familiar to you? You know, assets, because everybody know what they have as assets. Was there anything else that you saw on the balance sheet that you just never knew what it was? Or is it the first time you're hearing that term? All right, so I'm going to assume that we know all the terms that are there. However, I'm going to just go through some of the terms that are there. So the first one we have property, plant, and equipment. And it is what it is. So this would include like your land. All right, plant and equipment. Usually it's a stationary post. So if you're operating from a fixed structure, that may be considered your plant. And your equipment would be those things that you use within the operations. All right. In some instances, the fixed assets are just categorized as property, plant, and equipment. So all your computers, all your desk and chair, all of those things that you consider an asset would be categorized in the same area that is called property, plant, and equipment. All right. So if you notice, there is a number beside it, note 11. If you should go to that note, you will see exactly what makes up the property, plant, and equipment. I'm going to see if I can quickly bring it up and tell you what they had as property, plant, and equipment. I had the file open. Where is it? Hmm. I'm going to pull it from what I just sent to. All right, it refuses to open now. All right, I just wanted to show you what note 11 said, and you will see what property, plant, and equipment is. So when you're looking at the financial statements and you see a note number beside it, it means that you can look in the body of the financial statements and you will see exactly what they are referring to when they speak about whatever it is beside the note. All right, so note 11 here tells me that the property, plant, and equipment is made up of, let me see if I can bring it over here. Are you seeing another financial statement?
Yes, miss.
Okay, so you would go to note 11 in your in the financial statement, because this is like a book, remember? See, you're at page 83. So that's what your financial report looks like. So if you go to note 11, this is what it is, right? So you'll see the figure of 185,046 right here. And see, property, plant, and equipment is the heading, and it is made up of leasehold improvements, machinery and equipment, computer equipment, fixtures and equipment, motor vehicle work in progress. These are all the things that make up their figure in the financial statements here in the balance sheet of 185,046. All right. So you will have your term, you will have your note number, and you will have the amount and it will tell you, all right, inventory or stock. So if you notice, note 17 shows inventory. We have receivables, and we have cash and bank, and we have due from related companies. So some of these things were some of the things that you mentioned that you have in your business. So for Nicholas, with his vehicles, it would be in property, plant, and equipment. For Tanisha, you have inventory, or some persons call it stock. I didn't hear anybody speak about their receivables, people who owe you money. That is also a part of your assets. It belongs to you. You have cash and bank. Nobody mentioned that, but I would hope that you have some cash from your business stored away somewhere, whether in the bank or you have physical cash. And then we have what we call due from related companies. It's still a receivable. So due from meaning somebody owes you, but we tend to separate what comes or what is due from related companies. So if you have another business, Abiathar had spoken about some other business he had before, and that business was lending money or lending supplies or sharing resources, that would be a related company transaction. All right. So all of those things are accounting transactions and must be recorded. You don't just take it and say, well, because I own that and I own that, then I can just move the things around without recording it. They are accounting transactions and they should be recorded. All right. So that was for the asset part of the balance sheet. Now, somebody had mentioned something about software. I'm not seeing anything like that on their balance sheet, but you can have intangible assets. Intangible assets are the ones you can't see, right? But you still own it. So where you have things like trademark and branding and probably software, those things are intangibles. You can't see them, but they have a value and it contributes a value to your business. So that should be recorded as well on your balance sheet. And you will see it on some balance sheet. These persons don't have, but those things are to be recorded. All right, so like Matthew now with your Jamaica Bike Life, that's some form of branding or trademark, whatever it is, it has a value and it needs to be recorded in your accounts. All right, another thing you may find on your balance sheet is liabilities. Now, there's hardly any company that I can think about that will operate without borrowing, right? So let us look at what we have as liabilities. Liabilities now are going to be the things that you owe. So the assets are the things you own. Liabilities now are the things that you owe. So it may be in terms of payables. You buy from your suppliers, you don't pay them the same time, you have a credit facility with them, that is payables, right? You owe them. Then you may have things like director's account. So the director, who could also be considered a related party, may loan the business some money, and that is recorded as a liability. You owe the director, even if the director is you, it's a payable to that person, and so it forms a part of your liability. Lease liability is also a liability. So for instance, Abiathar speaks about perhaps leasing, I don't know if you lease facility where your operation takes place, or any of you lease facilities, that would be considered leasing. If you have any other leasing of items that you use for the business that is on a longer term. So for instance, let us even say the hearse. You don't have one for yourself, but you lease it for an extended period. So you may have an arrangement with somebody to lease that hearse for, I don't know, 2 years. You would have had a contract, and there would have been some amounts that you should know that is due to this person or this institution for the period of time that you have that arrangement. All right. So the
Yes,
lease liability
yes,
would
miss.
fall.
So question, miss. Would all right. So for removals, right? What we do for removals is we contract with a person that has a removal bus, and they would come in whenever there needs to be a removal. So, and that's the only time they'll get paid, when there is a removal. So their services are not needed outside of, there isn't a removal. So what would you call that, please? Should that be included as well?
Well, it's a liability. It wouldn't be a lease liability, because it would just be a regular, let us call it a regular payable, because it's just on a needs basis that you use the person. Yes?
Okay. Okay. Yes, miss. Yes, miss. Same
The
for the
person
earth.
knows, okay, that you're going to use their bus, but you don't have an extended contract to say, okay, every month you're coming for something and or a body, and it is that extended thing. It's just when the need arises. So when that need arises and the person comes, then it's going to be a liability is going to be there, but it is not going to be considered a lease liability. It's just a regular supplier and company relationship.
Oh, and a burning question from the last class, miss. We were talking about the employees section towards this, right? My employee, I only have my mother who is a permanent employee with me. Outside of that, I contract persons to get things done. So I don't think they can be considered an employee, because they are not working with me. They only should say they only do the job under another name. I pay that name to get the job done, and they do the work, and I come and pick up the bodies and take to the funerals and so on. So I don't think that would be an employee per se that I would have to pay tax for. That is what the
Right.
question is coming from.
Right. So, I mean, we look at the employer-employee relationship when we get further into the payroll section, but that doesn't sound like an employer relationship to me at all, because as we said before, it's just a needs basis, right? And then you pay them.
Right. Definitely, miss. Thank you. Definitely.
Mhm. All right. And then the last section,
Good question.
yes.
For that expense, what would you put it on under?
Which expense
Would
you
it be
talking?
salary in order to pay those persons?
No, man. So it would I would consider it a cost of sales. So if it is
Oh.
that remember we were speaking about, segmenting your account in such a way that you can see, okay, this is the service and this is what it costs to do the service. So it would be like, what would you probably call it? Transportation service or removal service. It would just be a regular expense. So that would not be considered payroll. Just a
Okay.
regular service expense.
Okay, even if well, I guess if it occurs and the statement say it's something that appears every week, say he has funeral functions and he's as a taking those persons every week, it's still considered as expense?
I would consider it as an expense, yes. So
Okay.
when I'm thinking about an employee, you're talking about somebody who comes to work every day, somebody who you dictate to them that they are supposed to do whatever it is. The person is solely responsible to you, right? So the person comes to work, the person sits at a desk or works in the yard or whatever it is. The person goes on their lunch break. The person has a set working hour from 8:30 to 9 to 5:30. The person uses your stuff. All of those things are suggesting employer-employee relationship.
Okay. All right.
But if the person just turn up just because if there isn't a funeral for a month, then that person is not coming. The person can go and look a job anywhere else. The person can migrate. The person can do anything, and Abiathar wouldn't have any control over the person. So do you have control over the person?
Okay. Thanks.
Uh-huh. All right. I did mention yesterday as well about the assets and the liabilities that they can be considered current or non-current based on their permanence. Permanence meaning, am I able to get rid of that or liquidate that asset or that liability quickly? So if it can't be liquidated quickly, then it would be considered permanent or more permanent than the others. So they would be treated as long-term. So if you notice, we have long-term or non-current, same thing. So if you notice, you had non-current assets and non-current liabilities. So they take longer to be liquidated. So the other section that you'd find on your balance sheet, it's your capital or equity. And that is what you use to start up the business. And it may be in terms of share capital, or capital reserve, stuff that. All right. So let's go and retain earnings. Retained earnings is really your accumulated profit or loss. We look at the terms further. All right, so I'm gonna go through some accounting terms. You can stop me if you have any questions on this. And this will be made available, right, Colin?
Could you repeat that? Could you repeat that, please?
I was saying the slides will be made available that they can go back through them, right?
Yes, yes, yes.
Okay. All right. So let's look at some terms. We mentioned assets and we were talking about assets over and over, right? But we're saying in order for the business to operate, you don't just need assets. You are going to have liabilities and you're going to have capital because the monies must come from somewhere in order for you to buy whatever you need in order for the business to function, right? And we just have these three terms: assets, liabilities, capital. And that's the crux of what makes up your financial statement. So what are the assets? The assets are the things that the business owns or controls and you use in order to generate your income, right? So the company benefits from the use of these items. We looked at some examples of your assets. It could be your land, your building, your motor vehicle, your computer, your inventory. All of those things are your receivable. These are things that the business owns, and so they are considered assets. Then we have the liabilities. What do you owe others? And these could be loans, your bank overdraft, payables to your supplier, payables to auntie and uncle, and payable to yourself if you lend the business money. These are all liabilities, things that you owe. So assets you own, liabilities you owe. And then there is the capital. And capital is really what you use to start up the business and anything, profit or loss, that is generated from the operations. So you may start out with your capital, start out with 100,000. You have, you made a profit during the year, that increases your capital. If you make a loss, then it erodes the capital. So your capital structure will be less. All right, clear?
Crystal, miss.
All right, so we looked at some of the terms. We generally, so here we have some other definitions. Assets, items of value or resources that the business owns or controls. Remember, if you don't own it or you don't control it, it is not an asset. So as long as it doesn't satisfy that criteria, then don't call it asset. I mentioned intangible assets. These are the things that the business owns or controls just the same, but you cannot see it. And we're talking about things such as your patent and your trademark, copyright, branding, and so on. The fixed assets, and the fixed assets are the ones that are those that are you own and you use in the operations of the business. Then the current assets, these are assets as well, but as I said, they can be liquidated quickly, usually within a year. Accounts receivable, still an asset, but it is money now that is owed to the business by persons, the customers or others on the outside. Receivables could be in the form of what your employees owe you. So that would be like staff receivables. Or if you borrow, let's not get into the borrowing money. I'm going to use another term instead of if you borrow money from the business. So let's not put that in this category. Then you have prepaid expenses, and prepaid expense is also a receivable. It is what you pay in advance for something you have not yet received. All right, why is it a receivable? If you prepay, if you gave somebody some money, right, and you don't get the item, that money is due back to you. So that's why it is considered an asset. Until the person who you paid to provide the service that you paid for, the goods that you paid for, that item remains a receivable, or those monies remain a receivable to you until the person satisfies that request. And I'm saying all of this to you because you need to have an understanding of where these things fall in your financial statements. When you look at your financial statement and you are seeing prepaid expense and you're wondering, what is this? I never buy anything named prepaid expense, but you will know definitely that these are monies that you would have put forward, but for which you have not received the thing. When you receive whatever it is, it needs to move from out a prepaid expense and go exactly to where whatever you bought, it will go there. All right. And then we move on to liabilities. Liabilities are the amounts that the business owes to another person or an organization. And we said it could be long-term or it could be current or short-term. So the long-term liabilities, things that you owe, but they extend over a year, while the current liabilities fall within a year. Then we have what we call accounts payable, right? Some persons may call it trade payables. It is really what you owe to your suppliers, right? Or creditors, same thing. These are accounts payable. And then accrued expense now. We looked at prepaid, where you pay and don't get the thing. So accrued expense now is where you recognize the expense even though you don't get the goods, right? So let us say you have a light bill. JPS did not send you your light bill as yet, right? And you are in the month. You know the light bill is supposed to come, you haven't seen it. You don't just pretend like that expense didn't occur. It did occur, you just don't have the light bill. So what you do is that you record the expense, but you need to show that that money is due, but you record it in an accrued expense account. All right, so you just use that account instead of putting it to JPS because you don't get the JPS bill as yet. All right, so any expense that you have incurred, whether or not you get the invoice in your hand, if you are doing your account and closing your accounting period, you need to make sure you record the expense. As long as you know about it, you need to record it. All right, don't say I didn't get the invoice and so I'm not recording it. You have to record it. And then we have bank overdraft. Bank overdraft is a liability. You have overdrawn what you had in the account, so you now owe the bank. That is an overdraft, and the overdraft is a liability. Right? And then we go to capital. And you will notice I'm breaking down the balance sheet into the 3 segments that I mentioned before and you would have seen on the balance sheet, which were the assets, the liabilities. So now we are onto the capital section. So the capital section, or the equity, is what the owner invests in the business, right? Now, I mentioned Monday it was, I keep saying yesterday. I mentioned that whatever you put in the business must have a value, right? And when you put that in the business, you need to record it, right? So if it is that you decide that, okay, I'm opening a shop and I'm going to get some groceries to put in the shop, right? You use your own money and you stock the shop. That is an accounting transaction. What you created was inventories for starters, because the goods are inventories. And if you are not claiming back the money from the business, it is capital. So you need to record it as capital and record it as inventory. Don't just leave out the transactions. Everything that you do has an accounting implication as it relates to the business. All right. And you know that your capital structure can come from you or it can come from investors in the business. Then we have what we call drawings. Drawings is really the amount of money that you as an owner take out of the business for your personal use. What that does is that it also erodes your capital structure. So if you started the business with $300,000 cash, for instance, and you started drawing money out of the business, that drawings is going to go against that capital. So if you took out 100,000, your capital is now going to show 200,000. All right. And then we have retained earnings. Some people call it accumulated profit. Same thing. It is really the cumulative earnings of the business. So whether it's a loss or a profit, that is where you have the retained earnings. It could be a loss or a profit. And that again erodes the capital structure of your business. So the more loss you have, the less your capital structure is going to look, or the worse, sorry. And if you have more profit, then it's going to look better. All right. So everybody recorded their capital. Tanisha, all your capital have been recorded?
Yeah, no. Honestly, no.
No.
With
So tell me about your business. When you started your business, how did you start it? I mean, it may be a long time, but how did you start it?
okay,
How did
I
you
would
start
have
it? Mm-hmm.
I would have invested funds from personal cash in the
So,
business.
so it would be your
But at the
money.
time,
Mhm.
pardon me?
So it would be your monies that started the business.
That's correct.
And mhm.
At the time I was employed, so I had to reinvest several times based on dishonesty of staff, a lot of reasons I had to reinvest. So to be honest, I don't even know if I'm really operating at a profit or a loss at the moment. And then I had in 2022, I had a big fire that I lost over 10 million in the
Oh,
business.
wow.
So
Oh, wow. I'm so sorry.
I'm not even sure where I'm at.
So even, I mean, even things like that, I mean, she spoke about the fire, and I guess my head is all over the place right now. But all of that is an accounting transaction in itself. If you're insured, then you know that you're going to have insurance claim and all of those things. When you get
Yes,
those
and I was
insurance
not.
monies, it is going to go on your accounts.
Yes.
Yes.
But I was not insured at the time. But I think what I did wrong, because right now I did not include it in as a transaction. So currently I'm having some issues with the government regarding taxes because it's as if I owe the government, but I don't even know how to deal with that because of not having proper recording.
So
Create an
all of
issue
that
for me.
fire story was recorded in your accounts that you lost stock and so on?
No, I did not. I did not.
Right. So what I want you guys to be mindful of is that whatever it is that affects the business affects your accounts. So there has to be an accounting transaction. So anything that happened, start to think, okay, how is this going to affect my accounts? Because all of those inventory that you lost, you should have taken them off your accounts. I hope you did. All of those should have taken off your account. So it would show that you should really be at a loss.
Yes, I'm aware that it should have been, but when you're a sole trader, I guess for this course, it came in at a very critical time for me because a lot of people will look at it. I am expanding, I'm doing this,
No,
and I'm reinvesting in all areas. But the truth is, it's when you put pen to papers to record everything, it's not as how it looks. So for me right now, I have to be as this course. I really appreciate this course right now. I would have had knowledge of basic accounting, but it really put me at a place now where I have to record, especially with the government on my case. So I realized how important detailing and record keeping is.
Okay. All right. So I guess when we get to coaching, we can see where you are specifically. All right. So yeah, just you all just keep the mindset. Whatever you do, and it has the business mark on it, it is an accounting transaction. It may be the difference between you paying tax and not paying tax. All right. Okay, so these were some accounting terms here. Right. Then we move over onto our income statement, our profit and loss. The first term is revenue, which is where a lot of us tend to look, but we don't look at the things that happen below it. We just look and say we make money. And when we say we make money, we tend to look at what we sold, but we don't look at the expenses that come with us making this money. So revenue or sales or income, same thing, is what is generated by the business when they sell whether the goods or the service that occurs with the operations. There may be another term, other income. So other income would be anything outside of what you were set up to do initially. So if you are set up like Tishana there to perform training services, for instance, all of the income that is training service would be recorded as a part of her revenue. But suppose now she decides that, okay, my computer here is old and I want to change it, so I'm going to sell it. That's not what you do normally. So it's going to be other income. So it would be categorized separately from this revenue that you would see on your financial statement, in your income statement. All right. So we want to make sure that we are classifying the things properly. Then we have cost of goods sold. Now, these are the costs that are related to your providing the service. So if, let me say Matthew, so I'm trying to use all the different businesses now. So if Matthew is going to go on a stunt show, right? We know that he's going to generate event revenue from that. But what are the costs that are associated with him generating this revenue from this stunt show? He may have to get, I don't know, costumes. He may have to get plane fare. He may have to get some other hands, meaning other riders or whatever it is. All of these are costs to the business in order to get the revenue, this stunt show revenue. So those need to be recorded as a cost. So if he wants to know, okay, did this stunt show, was this stunt show profitable? He would look at what he earned from it, look at all the costs that were associated with him earning that revenue, and the difference between both will determine if he made a profit or a loss. So if he spent more than he earned, he made a loss. If he spent less than he earned, then he made a profit, right? And this was where I was talking about this segment. So he could have a different thing. So suppose it's not the stunt show. Yeah, stunt show, but he also has, I don't know, exhibitions. So that's two revenue streams. What are the costs associated with the exhibitions? What are the costs associated with the stunt show? Which one is making a profit or loss, right? So that is what you need to look at. Likewise for Nicholas. Nicholas could say, okay, I'm doing the driving classes, right? What do you spend on gas? What do you spend on repairs? What do you spend on those things that are directly related to your to those revenues that you earn for the driving classes? Now you may find that the expenses, I'm gonna go down to the expenses a bit more. So let me not say that yet. So the gross profit, which I alluded to when I gave the example, is the difference really between the revenue that you generate from the activity and the cost of the costs that were incurred in generating that revenue. That is what gives you your gross profit or loss, right? So it could be a profit, it could be a loss, but it is just revenue versus the expenses to generate that revenue, give you your gross profit. Then we have expenses. Now, the cost of sales are also expenses, but it's just where they fall in your income statement. Because the expenses, you can't necessarily tie them to the revenue that you are generating. So it's more general, right? So your expenses could be things like your electricity, right? It could be things like your rent, any accommodation. It could be water, those things. If you can't tie it specifically to the activity, it's just a general expense, right? Or people call it administrative expenses. So it would be all of those expenses that the business incur that are not specifically related to the activity. And the net profit now is after you take out your expenses out of your gross profits, what is left over? Did the company make a profit or a loss? Overall. So you may make a profit on the activity, but you end up making a loss as a company because what you are generating from the activity is not enough to cover the other expenses of the business. Am I making sense?
Preach it, Miss Karen, preach it.
Everybody else with me? 2 minutes, Tishana.
Yes, fully with you. And I'm gonna go
Yes,
on
mate.
mine
Yes,
as
mate.
well.
Okay, you're leaving in 2 minutes, Tishana.
Yes, or in 1 minute so I can be on.
Okay.
to
No
start
problem.
at 10:15.
No
Yeah.
problem, no
Thank you for
problem.
remembering too.
All right, so yes, so that was the income statement showing you the terms. And I hope while I'm saying these, you are taking a mental note in your mind to know, okay, this is my activity, these are the costs that relate, this is, you know, so that you sort of know where you are and what to look for when you're trying to figure out if you're making a profit or a loss, or if your activity is making sense. All right. So now we're going to look at the accounting equation, right? And what is the accounting equation? What it does is show the relationship between the assets, the liabilities, and the capital, right? Now, because we spoke about the double entry concept, and I'm going to go into that a little further down, we want to know that we are, whatever we have in our business, we are recording it properly and categorizing it properly, right? So the accounting equation is saying that our assets, and this might sound a little technical, so just take a little time and look at it. Ask me if you don't understand. The assets is on your debit side, and it is equal to your liabilities plus your capital. Let us think about that practically. If you have a car, you're doing the car business, Nicholas, right? You have, the car is an asset. You start in your business. How did you get the car? You either bought the car, you got the car as a gift, you borrowed some money to buy the car. The car didn't just come like that, right? So you got your asset, and what you paid for your asset, or the value of the asset. Let us say the car is $500,000. There must be somewhere where that $500,000 came from. So suppose you put $300,000 towards it. You're starting up your business, you put $300,000, and somebody lend you $200,000. The asset is 500, the capital is 300, the liabilities is 200. That's how you get your 500. So you see the equation working out. The assets is equal to the car is equal to the 200 that you borrow. The car of 500 is equal to the 200 that you borrow plus the 300 that you put in. It has to come from somewhere. So you have to balance. Whatever transaction you do, it can't sit on its own. So just think about it. If it sits on its own, it's going to tumble over. It has to be balanced, right? So your assets, however you get them, is going to be equal to whether you borrow it or you put it in yourself. So assets is equal to liabilities plus capital. There's an equation that I have here that you can probably take a picture of it. And it says assets is equal to liability plus equity or capital, which is the same thing I just showed you a while ago, right? Assets, and these are just sides. And it might sound complicated, but these are just sides. Assets is on your right side, liabilities and equity on your left side, right? If the the right side is the debit, the left side is the credit. These are just sides, and it's accounting thing that has been made up from way back when. So I can't tell you why they chose credit as left and debit as right. It's just what it is, all right? So the assets are debits on the right and liabilities are credits on the left, liabilities and equity, right? Just like I showed you here. right? Debit side, left side, credit side is the right side. All right, and that's the equation there. All right. So back to the financial position. If you notice here, you don't see a left side and a right side, right? What we have here is a vertical format. That's how they present financial statements these days. Just top and bottom. The top part of it is the part that relates to the assets. And the bottom part of it relates to the liabilities and the equities. All right. If you notice here, I hope I am pointing. The total of the assets is 1148440. The total of the equities and the liabilities is 118440. That means that we have a balance. The assets up here is equal to the equities and liabilities, which is what we have on the equation. Right? If you look in 2022, it's balanced just the same. All right, so at no point in time should you have your assets being one thing and your liabilities and your capital being another thing. It means that you have done a transaction which did not conform to double entry. So both things you did not do a transaction like for like. Sorry. All right, and these are just showing where the different things are positioned. And I just did a note at the bottom here, which is really confirming assets equal liabilities plus capital. So you have to look on the sheet and you will see that the assets are the 64505. I don't know, when I point, do you see? Are you seeing when I'm pointing? Somebody help me out.
Yeah, man, we're seeing when the
When I point, when I'm moving.
Yes, miss.
Okay.
I see when I move the cursor.
Okay. All right. So, right. I was just showing you how we balance here in this balance sheet that is here. So if you notice, the assets are of two types. It's the current assets and the non-current assets, which is the 640 and the 507, right? And the liabilities is the 7888 and the 22, where am I? Sorry, the 137 and the 222. These are the liabilities, and then the 788 is the capital. The assets, these two added together give you the 1148. The liabilities come to 359882, the capital 788. It's right here on the sheet. And the two sides equal to the 1148440. So both of them are balanced. So if you ever take up this and you look at your total assets and you look at your equity and liability and you see there are two different figures, it means that something is wrong. It means that you didn't record something properly. All right. So no one-sided entry, please. Has to be two-sided. As I said, and I keep going at it or harping at it about you putting things in your business or using things that relate to the business. You can't be doing that and not recording where you got it from. All right. And if you take out things out of the business, it must go somewhere. So for instance, if you decide to take out some sodas or juices, Tanisha, and go give it to a school, it's donation. It has a financial implication that needs to be recorded. All right.
Okay, miss.
So the balance sheet, what the balance sheet does is that it shows the financial position or the health of the business at any given side. The assets are on the left side, debit, and the capital and liability on the right side. Somehow I thought I'd said it the other way around. I hope it's just in my head, right? So the assets are on the left side, which is the debit, and the balance sheet, and the liabilities and capital are on the right side. And as I said before, they should be balanced. If it is not balanced, you don't have a balance sheet. You have an imbalanced sheet, all right? And when I say the balance sheet shows the health of the financial position, if your assets, if what you have is less than what you owe, you have a problem. If what you have is more than what you owe, then you can say you are good financially, you're healthy. All right. So you see that all of this financial stuff that we're talking about is not just things that we talk about, it's things that give information. And it will tell you, are you wasting your time? Should you push more? Should you get rid of things? Should you get a lifeline? Because sometimes you may need an investor, or you may need to go get a loan, or you may need to get a second job, or something like that. So when you have your financial information together, you can make good strategic decisions. All right, and we mentioned this from inception, and we say it again. You cannot stand up on one foot, or else you're gonna tip over. Likewise, with your accounting information, it cannot be one-sided, or it's going to be lopsided, and it's going to be imbalanced, it's going to be incorrect. So the double entry concept is simply every entry should have an even number of transactions, right? Should be balanced at all times. And I don't want to say two, at least two, but it's not always two. Because as I mentioned with the motor vehicle there a while ago, you would have had the vehicle, you would have had borrowings, and you would have had capital, right? All right, and this is just a little thing to help you to remember what is on which side, and it's dead click. So dead on the left, debit, you debit your expenses, you debit your assets, you debit drawings. If you have anything like that, that's what you're going to do with those transactions. You're going to debit it. And for click, on the credit side, you credit your liabilities, income, and capital if they are increased. And you do the opposite if they are decreasing, right? So these are just where the accounts would fall on the financial statements. Anybody want to stretch? Bathroom break? Are we good?
I am good, miss. If anyone wants to stretch, that is okay with me.
Matthew, Tanisha, Nicholas?
Yes, I'm still here.
I was asking if you wanted to stretch or drink water.
I am okay so far.
You're okay. Tanisha?
All is well with me, miss.
Okay. All right, so we press on.
Would
All
you
right, so
like to take a 5? Would you like to go get something to drink?
who you talking, me?
You, Miss Karen, yeah, or would you
No,
like
well, you have an exercise on the thing right now. So you are going to look on the screen and you are going to say what these things are. So while I take my one, then you are going to look on the screen and you are going to say what all of these things are. All right. So give me a minute. Look on what is on the screen. That is your in-class exercise right now. What am I? Am I an asset? Am I a capital? Am I a liability? Matthew? Matthew?
Here I am.
All right, first 6. So you're going across. So motor vehicle shop fixtures, and then you stop at inventory. So tell me.
Cash at bank asset.
Motor vehicle is at the top, you see that?
Oh, motor vehicle.
Mm-hmm.
My motor vehicle is an asset.
Mm-hmm.
Shop fixtures. I'm not so sure about shop fixtures. Cash at bank is an asset. Bank loan is liability. Owner investments in business. Asset, inventory assets.
What is assets?
Inventory.
Mm-hmm. What is owner's investment?
50-50 about that one.
What is, tell me one of the 50.
150 would be asset.
And what's the other 50? What's the other 50?
A liability. Owner investment in business. Oh, capital is capital a part of it. Option too.
So, Matthew, tell me the key word in owner's investment in business. What do you think the key word is there, son? Or the keywords?
Owner's investment.
Mm-hmm. So if you own the business and you invest in the business, what is that? It's your business.
You
And
own
you
a business.
invest in it. What is that? Capital.
Capital, right.
Capital, right. What was bank loan? Just a moment, Abiata. What was bank loan?
Bank loan was a liability.
Okay, and shop fixtures was what?
I wasn't sure about shop fixtures, but
What do you think?
I figure you own it still.
Mhm.
So
So
it
the
would
shop fixtures would be like you have a shop and you have the things, let's say you have a store and you have the shelves and glass case, showcase and all of those things.
yeah, those would be assets because you own them, right?
Correct.
Them carry value.
Yeah. All right. Great. Abiathar, question, and then you're going to answer from receivables to amount owing to suppliers. No, I'm giving you too much because I still have, so I'm giving you from receivables to machinery, Abiathar.
Okay, miss. Noted, miss.
Mhm. You had your hand up though.
Say that again for me, please, miss.
You had your hand up.
Oh, yes, miss. I was going to ask, miss, if the owner's investment in the business, miss, would be considered owner's equity, miss.
Correct. Mhm. All right, so
Okay.
you are going to tell me from payables to amount owing to suppliers. No, receivables to machinery, sorry.
Okay, miss. So for receivables would be an asset, miss.
Mhm.
And for bank draft, right? Is that direction I'm going, right, miss?
Overdraft, yes.
Right, bank overdraft. So for the bank overdraft, that would have been a liability, as that would have been something that we do not own. For the payables will have been a liability because that's the money the business owes to its suppliers. And for machinery would have been an asset because it was a business owned to carry out whatever that the business is doing.
Very good. Good job, good job. Nicholas, from cash in hand to land. Nicholas? All right, Tanisha, can you take that? Tanisha or Nicholas?
Can I go again, Miss?
Yes, here. Sorry about that.
Okay.
Can you confirm? You said assets, liabilities, and what's the other one?
Assets, liabilities, and capital. So you're going to tell me from cash in hand to land, what category are they?
Cash in hand would be assets. So I go cross, right? As in
Yeah.
amount going to suppliers would be liability.
Mm-hmm.
Furniture's asset, land assets.
Okay, good. Thank you. Good job. Tanisha? All right. Loan from a friend. I'm throwing it out. Loan from a friend.
Liability means money. That would be money the business owes to a friend.
Okay. Money is paid in advance for goods not yet received. I was on that for a little bit. So let me see. Money is paid in advance for goods not yet received. So you have not received the goods yet, but you paid the monies in advance. What is that?
Liability means as a business does have an obligation to provide goods or services, whether or not.
You're looking at the one that says money is paid in advance, so you pay the money in advance, but you have not yet received the goods. You paid it, but you have not yet received the goods. Remember what I said? That is what you call a prepaid expense, a prepayment. You pay the money in advance. So if you don't get the goods, you are supposed to get back the money. So it is a receivable until you get the goods. Yes? It's a receivable until, so you are to get back your money if you don't get the goods. So at that point in time, it is a receivable, right? So if the person renege on the contract, they need to give you back your money. If the person don't give you the goods, then you are to get back the money, right? Look at the next one. The next one says money received for goods not yet received. So you collect the people's money, but you have not given them anything. This is the opposite of the one before. This now would be a liability because if you can't supply the goods, you have to give back the people the money. So at this point, it would be a liability. Think about it a little bit. You collect the people's money. You don't supply the goods. You have to give them back their money. So it's a payable to them, a liability, until you actually give them the goods. The one opposite before was true. If you pay the money and they don't give you the goods, they have to give you back the money if they can't provide the goods, right?
So I would like to put this in the contents where as persons would pay me for instance, a package
Mm-hmm.
or like for instance, a
Driving.
10 lesson package,
Mm-hmm.
right? They would have come in and do like maybe just one out of the 10. So the remainder would probably be a liability, I'm assuming.
Yes, what you have not yet provided for them, you owe them.
Yes.
Unless you have something to say no refund,
Yes.
right?
Understand.
So they pay for 10 lessons, they only turn up for 5. You still owe them for 5.
Yes, that's correct.
Mm-hmm. Yes. All
Give
right.
them a time frame, Nick. Give them a time frame, man. It's all right. You have to have 10 sessions within this amount of time frame.
Or
And
else they lose the
save
money.
yourself. Yeah.
Mhm. Yeah,
That
that's
was
what
my
person.
follow-up, miss. What if he does not have a time frame on the like should he input an expiration? Because for me, all right, for example, persons would have been interested in pre-planning. But how long
Mhm.
can you pre-plan for when you choose a set package and then we do not have the they do not know that we do not have the capacity to store what they ask for, but we take the money, so it now becomes a liability. But for how long? Because things are getting more expensive as we go along. Maybe by the time the person die, that package raised double, triple. So how do we?
So I'm just laughing but asking a question. So people prepay for somebody that's going to die? Huh?
You not necessarily die,
Oh,
because I
okay.
have I have pre-played arrangements already, you know. But what that does is a sense of security. So when death occurs, you do not have persons running up and down and making decisions that are already made by me. We try to cushion that, because when death comes, people are vulnerable and they tend to that's the time people tend to upsell, and you want the best and you want the this. So to cushion against that, we try to pre-plan. We try to encourage pre-planning. Plan before. It's not necessarily say you're called down dead in Jamaican terms, but you're
Mhm. Right. So if it is that you are pre-planning and somebody say, okay, I'm putting aside some monies just in case this person passes or whatever it is, and you want those funeral services, you actually owe the person the money. But you now need to determine, is it that you're going to take their money and put it in an account? Because you're not supposed to use it. You should perhaps have an account, like, I don't, like our lawyers have, I think they call it an escrow account. So when people pay down on that kind of thing, you need to put away their money. But you also need to ensure that you have something in place to say, this expires when, or it is going to, the cost for it is going to increase every 2 years if the person hasn't passed, or you can only hold that package for so long. But I think good planning, though, Abiathar, would ensure that you don't use the people money, because they can come and ask for you anytime and you would really owe them because you have not provided a service for them.
right, Mister. The money is made available, but for how long? Like,
Mhm.
I like that you mentioned 2 years. 2 years, every 2 years it would have been changed. But I would say 4 years then, because every 4 years then we'd have an election, or every 5 years, and that's when everything changes, tend to change. Now with the tariffs and so on, I'm not sure.
Oh,
Things are
Lord.
very unpredictable right now. But yeah, you get what where I'm positioning myself right now, miss.
So your contracts are important, because
Yeah, man, you have to
somebody
pay a
would.
money for secure it annually. You know? I know say after a certain time, that you better make sure say.
No, and people, I went to a funeral, right? And it was overseas, and the person before they passed, they would have she worked out her funeral arrangement and so on. And she made her payment. So when she passed, she said she didn't want to be a burden. So when she passed, she had like a limousine and whatever. But of course, by the time she passed, the limousine that they get was like an old limousine, because I guess that's what the package could afford. So the question is, do persons go back and up their deposit, or they just leave it? But the
Yeah,
point is, at
all
the end
that
of the day,
kind of stuff should be in the details, you know.
yeah,
Know that after a certain amount of time, you know,
mhm,
you have
you
to
make
top
sure
up
that you put it in your contract.
something like that.
Every year, if you don't perform the service, it is going to go up by 5%, or it is going to go up, and you need to make sure them pay it.
Yeah, something like that makes sense
Mhm.
to keep the
Awesome.
business earning while time, you know, time
Mhm.
pass. Because once that money is injected into the business, you know, or you separate your profit and just put away the money that is designated to what the people need, you know.
And that's why it is important to make sure that your written contracts are, I'm sure you may have done, or you are going to do something to do with the whole legal matters concerning your business, because you don't want to hang yourself carelessly with these contracts, and then you find that you end up with problems. So you may say to yourself, okay, I'm going to create an account just to put the deposit, or a percentage of the deposits. So God forbid anything happen, then you would be able to give back the monies, or somebody will know where to find it. So all of
Yes,
those.
miss, we have a little fund that we intend to put that money in, miss. Nobody has paid it upfront yet. Someone has paid half, but the person has died and the family has come forward with the remainder of that, and it
Rest.
was successful. We had another situation where
So you
we
see, sorry, Abiathar. So you see
go
where
ahead,
you
miss.
said, where you said the person had paid a half, then you should have recorded that as a half. Right? And then when the person passed, you should record the entire amount, set off the half that you get, and the rest would be receivable.
That's what I did, miss, but it was funny because I had to wait some time through the NIS, miss.
It don't
So I
matter.
had
It
to
would still
dip
be
into other
receivable.
money to fund the funeral until.
Yep. All right. So good job. So Nicholas, you know that you need to ensure that you record your part payments properly for those driving classes and so on. So
Yes,
you
I would have a structure.
have a
I think I
structure.
use Excel to
Or you use
every
Excel.
month. Yes, every month I would have a list of new persons that have coming in, the things that they're doing, amount that they paid and stuff like that.
Okay. All right. Good job. And then we have the last one now. So money is taken from the business for personal use. You know what I call? Anybody knows what that's
Don't do
called?
that. That name, don't do that.
Drawings. I mean, it's your business. You can take drawings from it. You can take monies from your business. But one thing we need to know is that if you take monies from the business, you have to pay tax on it. Right? You need to file. So if you are not taking a payroll, for instance, some persons will say, I'm not taking pay from the business. But you are drawing monies from it. You should be paying tax on it. Because the business, it is not recorded in the business as an expense. If it were an expense in the business, then the business itself will pay tax on it. But if you now start to take the monies, you need to pay tax on it. Okay? So the tax person can look at the business account and see drawings and then turn to you and say, did you pay tax on these drawings? All right. Everybody quiet. Oh.
Yes, miss, was just taking notes, miss. Thank you for the suggestions, miss.
Tanisha, you still with us?
Yes, I am here, just multitasking. Sorry about that, but I'm still
Okay.
listening.
Okay, so you saw the examples that
for
we
the
did when we were
assign-
classifying the asset, the items?
Yes, I did. I did.
Okay. All right, so we're going to
Miss,
go.
I'm back and it says assignment. Are we just starting the class assignment?
Yes. You're back?
I am back.
Oh, okay. That was quick. Mhm.
Yeah, it was just a presentation I had to make.
Okay. All right, so we're going to look at, this is just going to be us identifying some accounts similar to what we were doing when we had the list of accounts, but you're going to have a statement now of an actual transaction. So we're looking at Farmer Joe, John Brown, who's a sole trader, and he started a mango sales business. And in January 2020, dates are important. And he purchased some mangoes from Clarendon Farms, and he's going to sell to market vendors. And so we're going to look at some of the source, some of the information that we gathered from his source documents, because we want to make up Farmer Joe's accounts, right? So we're using his source documents for starters, and we want to see what is going on there. So what we're going to do now, we're going to look at the transactions and try to figure out how to record it, what the things are that are affected, and then ultimately how it's going to be affected. All right, so the first transaction, it started on January 4. And as I said, date is important. So when you're recording your transactions, make sure that you have a date beside it. Because if you want to analyze your information by particular periods and you don't have dates, then you don't know when what took place. All right. So we're working in the month of January. So he cashed a personal investment, $50,000, and deposited monies to the business bank account. So what are the accounts affected here? So you can speak, whoever it is, you can speak. I'm not going to be calling on you now. Just give everybody a chance. Number one, he cashed a personal investment for $50,000 and then he deposited the money to the bank account. Which two accounts are affected?
Asset, miss.
You have to tell me, remember that there are two accounts that are affected. So not one, two. And you have to explain it to me.
Asset owners equity, miss.
It's two, you just gave me two?
Yes, miss.
Okay, so you said owner's equity and assets. What is the asset?
The asset would be the money that he deposited into the business, miss. The business now owns it.
Right, so the money that he deposited to the bank account. So the bank account now has the money, and the capital or the owner's equity also has $50,000. So you see where we have two entries. The owner's equity is the capital, which is going to be $50,000, because that's what he's injecting in the business, and it's going in the bank account. So the bank account is an asset, so it will also have $50,000. All right?
Yes, miss.
So that's the first one. So then on January 20, he transferred a pickup valued at $350,000 to his business. What is affected? Not you, Abiathar. Somebody else. So he transferred a pickup. This is his business. He transferred a pickup, and the pickup is valued at $350,000. He transferred it to the business.
It become an asset.
What is an asset? You have to tell me. Tell me what is.
The pickup truck,
Mm-hmm.
which is valued at 350,000.
Right. So you're going to record the pickup truck as an asset with a value of $350,000. But Matthew, you now have one side entry. Where's the other part going? Where did he get the pickup truck from?
Because it was his own.
So
Eh?
if he took his own and he transferred it into the business, what is that? Remember, own
Yeah,
is
but it's
own.
the word transfer, it's transfer really hold me this one.
You just turn it over, but it was
Yeah,
its own.
right.
So if it's his own, what is that?
Capital.
So we have a truck that is now going to be an asset to the business, but it is also a capital injection because it is the owner's amount that he's putting into the business. The statement did not say he bought it from the funds. The statement did not say somebody lent it to him. The statement did not say any of that. He transferred it to the business. He just started the business on January 4th, and he transferred a car, a truck, valued
Right.
at $350,000. He didn't transfer money. He transferred an asset, which
Right.
is the truck. So asset account is going to have that 350 and his capital is going to increase. So you see here, he has capital of $50,000, which he deposited in the bank, and he now has a truck as well.
Miss, but how do you really transfer a pickup truck to your business? Do you change the ownership on the title, or you just say, may I transfer it to the business?
You can change the title on the business, on
Yeah,
the
you can
thing
put
here.
it in the business name. You can change over the
Because one of the
the
things you see,
licensing on it from a regular vehicle to a transport vehicle.
one of the things when you are, especially when you're doing an audit and you say you have a vehicle, one of the things that the auditors will check is the documents of the vehicle. So if you have a vehicle and you have it on your accounts to say that it is your vehicle and the papers are not in the name of the business, then they're going to say it's not the business vehicle. So it may be like a loan, it may be just something that you're just using in the business.
So you see, 1 second, not to cut
So
you,
you
Miss
have to
Karen,
prove
but I was
ownership.
looking for the debit, right? I was looking for the debit somewhere.
Debit assets, credit
Yeah,
liability.
because what happens is the money, him can transfer it, Tish. Him can transfer it, which is not a cost because he owned the vehicle already. Him just transfer it to
You're just
the
changing the name.
company, but him have to pay for the transfer of the documents and these kind of thing. So that come at a cost, and that
Well,
all.
we never get get into all of that.
No, I just made it that because, like
Yeah.
me tell you, the word transfer did hold me because I was looking for a debit and a credit, instead of.
Transfer in this sense just means that he made the vehicle, the company's vehicle.
Right.
But if he did not transfer it, if he did not change the name of it, then the company cannot put it as an asset because a part of the thing being an asset is that you have to own it. And if it is not in your name, then you don't own it.
Correct.
Question.
Yes,
Do you
Tanisha.
think okay, because for me, I think I'm also in some when I started out, most of my all my vehicles are actually in my name. But I find that with this whole audit and all that, I'm about to get in trouble because it's as if I'm using the business funds, even though I would have been employed. So having acquired maybe 5, 6 vehicles in my name, it's as if these are profits I would have made from the business. Is it safe to have the vehicles in your name or in the business name?
I can't necessarily tell you the advantages or disadvantages right now, but one thing I know is that the tax allows you to claim expenses from your personal assets, which are reasonable or reasonably used in the business's operation. So suppose it is that you say, okay, the all of the gas, you use it in the operations. So you can say, okay, the vehicle is used solely for the business operation. So every gas bill that I have is for the business. You can claim it in your business. But you may have a challenge when it comes on to if you're paying a loan. Because I think it's just the interest you can claim for the business, not the loan payment. Whereas if you had, let us say you borrowed money to buy the vehicle using the business name, then the business could be paying back the entire amount of the loan.
So even though it's in my name for those gas bills and insurance, it is safe to go under the business because
You
they
can put it
most
under the business name as long as it is reasonable. They use the term reasonable and they open it up for you to determine what's reasonable. They didn't say, okay, 60% or 70%, but you can say, I use it 60% at the time, or I use it 70% or all of the time. And then you claim
that's
that.
because what is reasonable because it is used for the business. It's just
Mhm.
that they were all registered in my name.
Right. So if you can say it's used 100%, then you should be able to claim back the expenses as long as you know that that's what it is. But why you don't want to have the vehicles in your name, it would help your accounts too. It would help you if you want a loan because it would, you remember we spoke about the health of the business. So it would increase your net worth there. So if you want to go out and get a loan, you could show that these assets are the business's own.
Yeah.
Any particular reason why you have them in your name but using them in the business? Just asking.
It's just okay. When I started out doing business, it was just a small thing. So gradually you purchase a vehicle. So it was just purchase. You wasn't really thinking of expanding the way in which I would have expand now. But now I'm seeing all the issues coming up because having all of these motor vehicles and they're in my name, it creates an issue at times. Even for me, um, even with the bank account, even though it's a business account, I find I don't know if it's related to this, no, it's not related to this. But operator, Western Union, and then wholesale, and like if I go to get a loan, I have to separate. No, I'm actually have to be separating the business account
Yes,
because
ma'am.
they don't want to give you a loan when you have a Western Union. So I have to separate the accounts. So it creates a lot of things I wasn't foreseeing because I wasn't thinking this big. So it creates so for the vehicles I now have to be going through the process of transferring them over to the business.
Have you gone to the tax office and asked them to help?
I have consulted an accountant, so I
They have tax people, that you can actually sit down with and talk to that will help you, They have people there that are willing to help because I believe some of them are reasonable, some of them are just difficult. But you can find somebody there that can help you with your tax planning aspect of it. Because I know that's one of the challenge entrepreneurs have where they mix up everything and then when it comes to
yeah,
tax time and trying to separate the things, it's a headache. But they have some good resource persons there that can help, that are willing to help. I just need to find one and sit down with them. Because as I said, at the end of the day, you can't do two different accounts. You have to do one account. So what belongs to the business and what belongs to you? And you can have it belonging to you in one report and belonging to the business in another report. You just have to be clear on that. All right.
Yeah, thank you.
All right. So February 8th, Mr. Brown purchased mangoes paying from the bank account. Which accounts are affected? So remember, he's in the business of selling mangoes, and he's now buying mangoes and paying from the bank account. Anybody wants to give a shot at this?
Inventory, miss.
Good. Why did you call it inventory?
He
Why didn't
used
you
it
call it an asset?
because he purchased the 20,000 mangoes, miss. So he's basically holding on to the mangoes for future sale, miss.
Right, because he's going to sell it back. So what he's buying to sell would be his inventory. If he was keeping it, like so you know that you can have a car, you can be in the business of, let us say, car sales. Yeah. And you find that you have cars in your business that are inventory and cars in your business that are assets. So if you have trucks and so on in the car sales business, right? Those are you have cars. Let us stick to cars. You have cars that the manager drives or the salesperson drives or whatever it is. It belongs to the business. But in this case, it is not something that you are going to sell. So that would be an asset. But the ones that you have now that you have in your inbound warehouse or whatever it is, these are inventory items. So I just wanted you to understand the difference between what is inventory versus what is an asset. So you got it right, Abiathar. It's really inventory. And what would be the next side? What would be the next side, Abiathar? All right, so the other side would be bank, because he's taking the monies from his bank account, right? Remember that he had put some cash in there and he's just buying the mangoes cash. Buying the mangoes using the bank account.
True, miss. True, miss.
Then he borrowed $5,000 from his wife to purchase 2 wheelbarrows for use in the business. So what we have here is him borrowing money from his wife. So he now owes his wife $5,000. So that's going to be a what? Nicholas?
Yes, I am here.
He borrowed $5,000 from his wife to purchase 2 wheelbarrows for use in the business.
He borrows money from his wife.
Mm-hmm.
Is it his wife and his business, or it's just his? Well, once you're married, still.
Okay. All right. Well, why, Nicholas, why you have to get so technical?
Come on, I like that answer there, Nicholas. I like that one there.
Oh my word, I didn't even think about it like that. Okay, but go right ahead. The answer has not changed. Where are you?
I am currently driving.
Oh, No, I didn't see you answering the question, so that's why I was asking, where are you?
Okay, okay.
So if he borrowed the money from his wife, what is happening there? By the way, your eyes on the road?
Yes, my eyes are very on the road.
Okay.
So he borrowed money. Where is that? Oh, number 4, right?
Yes.
March. So I must choose which one of them, please.
No, you need to tell me which accounts are going to be affected. What am I going to do with this transaction? Liability, capital, assets, what is affected?
Liability, capital, assets, liability, capital.
Why you say that?
Hold on.
Wife
Right.
capital.
Capital, liability, assets, capital, liability, assets. He borrowed from his wife. Assets, because it's not from the business. So assets,
What is the asset? Which is the asset?
5,000.
But he used the 5,000 for something. I remember that we need two sides to the entry. You have to balance.
I'm not really incorrect. Probably because me a driver now, folks.
All right. So he borrowed the $5,000 from his wife to purchase the two wheelbarrows. So what we have now is a liability because he borrowed the money, so he now owes his wife.
Right.
Yes.
And the wheelbarrow would be the asset.
So he now owes his wife $5,000. So that's a liability. But he bought two wheelbarrows, right?
Yes.
So you have the wheelbarrow as an asset, or the wheelbarrows could be considered like loose tools. Some persons, depending on the value of what they spend on, they will say, oh, a wheelbarrow is going to, mash up in 2 months. So I don't want to consider it an asset. So it could be an asset for you, or it could be repairs and maintenance or loose tools, whatever you want to call it. All right. But the idea is to have the two sides of the entry. He borrowed the money from his wife, he now owes her. So it's a liability you created there. He got a wheelbarrow or two wheelbarrows, and that is going to be an asset, or repairs and maintenance, whatever you choose to call it. You saw that, Nicholas?
Yes, I envision that.
Okay. And then he purchased 20,000 mangoes at $12,000 from Clarendon Farms, and he got this on credit. Tishana?
I didn't hear that, Miss Karen, sorry.
He purchased 20,000 mangoes at $12,000, but he got it on credit from Clarendon Farms.
Yes.
What's the entry? How are we going to record it? What is affected, and how are we going to record it?
So is it still in an expense even though, it's still an expense even though it's on credit?
Why you call it an expense?
Or is it a cost?
Okay, he's in the mango business, right? That's what he does that's what the business does. So he buys and sell mangoes. So in this case, the mangoes will be inventory. Yeah.
So the mango is inventory. But it's money that he has to pay out to secure the goods.
Right.
To sell.
So what are the two sides of the entry? Two things affected here.
So the $12,000 is going out, and the inventory, what do you call it now? When he buys the 20,000 mangoes, that's now asset, because inventory is asset, right?
Right. So it will be inventory, asset. And what is the other side of the accounts?
The credit, the $12,000 credit that he now has is a
Right. So
liability.
in liability. So he now owes Clarendon Farms
He
$12,000. So that's
owes
a
and he owns
liability.
20,000 mangoes as a part of his
Right.
inventory.
So you see, he owns the mangoes valued at $12,000. He didn't pay out any money, but he owes somebody.
He owes it,
He
so it's
has
a
now created
liability.
a liability, a payable to Clarendon.
Accounts payable, yeah.
Right. All right. So where are we now? We're at 11:17. So this is what we did, what we were identifying. I just have the answers here. All right, so you can look back at the answers, which we just went through. Whoops, sorry. Sail back in, right. So here is just exactly what we went through, where we identify the transactions, and we were just trying to figure out if it's an asset or a liability or capital. And this is what is written here in red. All right, so when you get the slides, you can just look and refresh your minds with that. All right. Okay. So now this part is going to be, well, no, you probably have to look. Looking is going to be what we do here. Now we have 5 transactions. Now, all of this that we have here, we were just talking about it, right? So we got the source document. Mr. Joe Brown just gave us all of this information, whether I wrote it down or he had an invoice or whatever he had. This was what we picked up from the information he gave us. So the question is, what do we do with this? He gave it to us. What do we do with it? We need to put this in some form of a manner that makes sense, because just looking at the transactions like this, it don't make any sense to us, right? So remember, keep in the back of your mind the accounting cycle. So here's what we do. Do you remember the first thing after we get our source documents, what we do? Shout it out. After we get the source documents, the first thing we do is what? It's right in front of you. After the source documents, we move to our journal entries, because we're going to take all of that information which Joe just gave us, or which you in your case have all over the place. So you have your little receipts, you have your thing in your book and all of that. So you want to make some sense of it. So we're going to do what we call journal entries. Now, this is all manual, right? But when you have your software, you can type them in there. You can go and input it, and when you input it, it's just going to throw out everything at you, right? So remember, we spoke about the assets and the liabilities. I'm trying to hide this thing. Okay, right. Remember, I told you to keep in the back of your minds what happens when assets increase and liabilities increase and so on. What goes up, what goes down, what is debit, what is credit. So all we're doing is just translating those information that we spoke about a while ago into a journal entry, which is the second part in the accounting cycle. So when an asset goes up, if you look here, you see it. An asset is on the debit side. Remember, we look at dead and click. So assets is on the debit side. When it increases, or when it goes up, on the debit side. So the first transaction that we had relating to him putting money in the bank, we debit asset and credit capital. So this is how you record what the owner contributes to the business, right? When you get the slides, you can look at the transaction and you can look at the journal entries that we're doing. All we're doing is recording it in our system. When we got the motor vehicle, it increased our asset, so it's a debit, and it increased our capital. Capital is on the credit side, and so that is where we have it here. So we record his truck. Then he bought the mangoes. If you notice here, we have two assets being affected. It doesn't matter. The two of them can't be going the same direction. So the inventory was increased because we bought the mangoes, and our bank account went down because we see it here, credits. When there's a decrease in an asset, which is the bank, it's a credit. So the mangoes from Clarendon Farms that we paid for from the bank increased our inventory, but it reduced our bank account. Then he borrowed some money from his wife. We got the equipment in terms of the wheelbarrows, and that was valued at $5,000. And we now owe Wife Brown $5,000, which is a liability. Here it is. The liability is increasing, but we are now owing it. And so we have $5,000 for the purchase. And the last one was when we got the inventory again, but this time we got it on credit. So our inventory, which is an asset, went up, and our liabilities, which is now a payment to Clarendon Farms, went up as well. And so we record it as a credit. All right. So this here that we just do is just translating. I'm trying to click. What we just did is translating. Sorry, I don't know why I'm there. Why am I there? Right. So this that I just showed you is just taking this information. Remember, this is why source documents are important. All of these information you have, and you are now trying to turn it into a financial statement, so you record it via journal. All right. So from your journal, remember that your journal spits out. Who can tell me the next phase in the cycle?
General ledger.
You move to the general ledger. Thanks, Matthew. So remember now that the general ledger, the journal is just recording the transactions. The general ledger now is like a deposit, a repository. It just stores the information. So this is what is happening. So from all the journal entries that were going on in the bank account, you have two transactions taking place here. The capital that went in when he started and the $10,000 that went out. So if you just look at this, 50,000 minus 10,000, you will see that you have 40,000 left. All right. But when you're closing off the books, you have to actually do it to show the $40,000. Capital, you see the two entries coming in. You have the $50,000 that he had for when he started and the $350,000 when he brought in the motor vehicle. So his capital is now 400,000 if you just look at it. The inventory, he bought $10,000 worth and he bought $12,000. So you can see here, $22,000 was spent on the mangoes. Again, and this is just details, your journal entry, the same thing that you record, it is just grouping the things now based on what it was. One thing in equipment, which was the asset that he bought, so the opposite entry in the liability as a loan to Wife Brown. Then you owe Clarendon Farm $12,000 and you now have a motor vehicle for $50,000. So this is what your journal entry is doing. All right. So all I did here was just summarize. When I was adding a while ago, just looking on them and adding, this is just adding them now. All right. So when you balance off the accounts and it will show you what is going to go to the trial balance. So remember we had 50,000, we take out 10, so it's 40,000 we have left. So it is a bank account, is an asset, so it has a debit balance, right? So these figures in blue, these are going to our trial balance, right? So all that is happening is that the entries are going here, the movement in the account, and it is showing you what is left in the account. And it is what is left in the account that is going on our trial balance, right? You have to sit and you have to just look at it to see where the transactions are moving through. So you see, the bank had $40,000 when we were finished. Capital at 400,000 when we were done. Asset of the inventory, sorry, at $22,000. Then we had the wheelbarrow for 5,000, the loan for 5,000, what we owed to Clarendon Farms for 12,000, and the motor vehicle, right? So after the general ledger, where do we move to next? And I'm saying this to you, it might seem a bit complicated, but if you have a software, once you enter the journal entry, it does all of this. You're seeing me doing this because it's manual. All right, but it is really showing you what happens in the background of the software that you are using. So when you are putting the information in your software and you want a general ledger and you print it and you get something like this, you will know if it is really making sense. Because if you put the journal in the wrong way, then your general ledger is going to have the wrong information. All right, so after the general ledger, what's the next part of the cycle?
Trial balance, miss.
Trial balance. And remember now, the general ledger is a detail. The trial balance just has balance. As it says, it's just balances, right? And the trial balance must balance because you would have observed the double entry when you were doing the journals, right? So your trial balance must balance. So here is the trial balance. That's all the trial balances. It takes up the debit balances. So you remember assets have debit balances. The bank is an asset. The equipment is an asset. The inventory is a balance. The motor vehicle is an asset. And so they have debit balances, right? So you see, total is 417, capital is 400, the loan is 5,000, the payables to Clarendon Farm is 5,000. So at the end of the day, you have 417,000. So you are in balance. If you have two different things, it means that something is wrong. And all of this information that you see here is coming from where we started. Where did we start? Remember, we're running a marathon here. We started from the source documents where we identify the things and the values. Then we put them into the journal entries, meaning all we did was record the transactions based on the source documents. It categorized them into the general ledger, so you see all the details. Then what is left over after the ins and outs of the accounts, we ended up with our trial balance. And that's where we are, our trial balance. And what is the last stage now?
Financial statements.
Financial statements. So, well, these are just some notes which I mentioned before. So this is the first of our financial statements. See? Now this format is called the horizontal format. If you remember in spur tree, it was one on top of the other. So if you were using spur trees format, then everything would come down in a vertical way. But I wanted you to see the balance in here. So current assets, non-current assets, the equipment and the motor vehicle, plus the inventory and the bank, give it a 417, and the liabilities, current liabilities and the capital, give you 70. Simple balance sheet. So right now you can look and you can say, okay, my total assets is 355,000. My current liability is 17,000. You can look and you can say, okay, I have $22,000 worth of inventory and 40,000 in the bank. My capital that I've invested so far is 400,000. You can look on your balance sheet and you can see that. You can see you're in a good standing because your assets is more than your liability. You have over $417,000 in assets and you only have 17,000 in liability. So you're doing good. All right. Remember, the balance sheet shows or tells you about the health of the business. All right.
Yes, miss.
Have I lost anyone?
No, miss, not at all.
Oh, I haven't lost you, Abithia, and I haven't lost Matthew.
And you haven't lost
Nick,
Tishana.
I haven't lost Tishana. Tanisha and Nicholas, you good? All right, I know Nicholas is driving and Tanisha is multitasking. All right, so that was a run through. So, lots. I'm going too far. All right, so do we have any questions on this? I know I haven't lost you, but any questions on how we move from one section to the next, how we interpret what is happening here? All right. So we're down to, can you believe it, our last slide. And it is your turn to practice. But these are questions that I actually wanted you to do at home. So what I want you to do, you have questions A to K, right? So you're gonna do something similar to what we did. You're gonna look to see what are the two accounts that are affected. You're going to say whether it is asset, liability, capital, revenue, or expense. You're going to look at the double entry, which account is to be debited and which account is to be credited, right? So this is about J. Marie T, and she owns a professional shop and she has these transactions during the period. So for instance, J. Marie invested 300,000 in the business, which she lodged to Popular Bank checking account. Which two accounts are affected? So we see the capital account there. And we see the bank account there. What are they? They are assets, they are capital, right? That's all you're doing. And you do it just like that going down. So identify the accounts that are affected, the types of transactions, and the double entry. That's all you're doing, right? If you look, for instance, at, and I'm just going to show you this one, HI. So I spoke about, she performed services for 132,000. She received some in cash and she received the rest she owed the rest to Maxwell Brothers. You are seeing three different things happening there. But at the end of the day, remember that you must balance, right? So for here, if she performs services, it would be revenue, right? And she received some money in cash, so the cash account or the bank account is going to be affected, and she owed them, so there's going to be a liability as well. One of the things I want you to remember as well is that in this instance, she performed the services for 132. Not because it's only 60,000 she received in cash. She should only receive 60,000. We don't record on a cash basis. We're recording on what we call an accrual basis. That's how we record our accounts, right? So what does that mean? It means that you need to record the revenue or the expenses as they are incurred, not when you receive the money for them. So in your books, you are going to record the revenue of the full amount of $132,000, right? Not 60, because you only get cash for 60 and you don't get the 72. It has to be the entire amount that you record. All right? So even in your own business, if you are doing that, you don't record based on when you collect your cash. You record based on the full amount of the service. Now you have some instances where the services may be in part, right? And then you can record like that, but not when you have completed the service. It is not dependent on what you collect. It's dependent on when you have completed the service. Is that clear?
Crystal clear, Miss Karen.
All right, so do we have any questions?